Hey everybody, welcome back. Donnie Eisenhower here. And if you're preparing for the North Carolina Post 302 final exam, you're in the right place. Today, our review covers Section 5, Closing Disclosures. And if I could give you one piece of advice, do not skip this section. Many students get nervous because they see math problems and the closing disclosure worksheet. But here's the good news. The exam is not trying to trick you. It simply wants to know if you understand who pays what, when it's paid, and how to perform a few basic calculations. So today I'm going to simplify all of that for you. If you find this video helpful, please hit the subscribe button below and don't miss future post-licensing videos. Also, don't forget to download today's worksheet and follow along as we go along through this video. Let's jump in and get started. The closing disclosure. You may also hear it as the CD. The closing disclosure replaced the old HUD 1 statement way back when. So what you want to think of the closing disclosure, or the CD, as the final financial report card for the transaction. It tells everyone who is paying what, who receives what, how much money is due, and how much money is being financed. So remember this, the closing disclosure timeline is non-negotiable. It cannot be waived. You remember? The buyer must receive the closing disclosure 3 days prior to closing. That cannot be waived. You want to know this for the exam. Now, seller closing cost. Many times people get confused buyer cost and seller cost. Think about what belongs to the seller. The seller usually pays for things connected with transfer of ownership. This is a big one to remember. They typically paid for the deed preparation. Other common seller expenses include excise tax, existing mortgage payoff, lien release, seller attorney documentation. So ask yourself, which of the fees typically gets paid by the seller? Your main answer that you want to understand is the deed preparation. Now let's transition and talk about buyer closing cost. The buyer usually pays costs that's associated with obtaining the loan. That would include the loan origination fee, appraisal, credit report, title insurance, closing attorney fees, and mortgage insurance. So simple memory trick here, a loan goes with the buyer. If it's financing, the buyer typically pays for it. That is typically something that the buyer pays for, is financing related issues, money, things at closing. Now you also may see on the closing disclosure, POC, paid outside of closing. The money that has already been paid for before settlement. That is because someone already paid for that item. It isn't collected again at closing. So if you see POC on the closing disclosure, don't charge it twice because it already has been paid. Now, due at closing formula. This is probably one of the easiest math questions on the exam. The formula is purchase price minus due diligence fee minus earnest money deposit. That equals cash due at closing. So let's look at a problem here. You got the purchase price minus the due diligence fee. Earnest money equals cash due at closing. So let's say the purchase price of a home is $500,000. The due diligence fee is $600, and the earnest money deposit is $2,400. So remember, you take the purchase price minus the due diligence fee minus the earnest money deposit. That gives you cash due at closing, and then that would be $497,000 due at closing. Let's talk about commission calculation. This is pretty easy too. So you got the sales price times the commission rate equals the commission. So for example, a sales price of a home is $400,000. The commission is 3%. That would be $12,000. That's exactly how every commission question is solved, straightforward, no tricks. Let's talk a minute about excise tax. Don't overthink this. North Carolina excise tax formula is this. You round up to the nearest 500, then you divide by 500. That's your excise tax. So let's say, for example, the purchase price of a home is $346,600. You round that up to $347,000, then you divide that by 500, then that gives you $694 for excise tax. Very straightforward. Here's where it might get tricky a little bit. Property tax prorations. So here's the concept. Property taxes belong to whoever owned the property during that time. So if taxes have already been paid, the buyer reimburses the seller. If taxes have not been paid, then the seller credits the buyer. So instead of trying to memorize every example, ask yourself this question. Who actually owned the home during that time? Then that is who pays the taxes. That is ultimately who will pay those taxes for that period. Prorated rent. If the property has tenants, rent must be divided. So the formula for that would be days remaining in the month times daily rent amount equals the prorated rent. So again, the exam isn't trying to make you a CPA, it's just testing whether you know the process. So let's talk a moment about interim interest. Interim interest is a common question. Here's why. Mortgage payments are made in arrears. What that means is you pay interest after you use the money. So if you close on October 14th, your first payment isn't for October. Instead, you owe interest from October the 14th through October the 31st. So the formula is days times daily interest equals interim interest. It's pretty straightforward. So let's do a problem here. A buyer obtains a $325,000 mortgage loan at an annual interest rate of 5.25%. The settlement date is October the 14th. Remember, the mortgage interest is paid in arrears, so the buyer owes interest from October the 14th through October the 31st. The question will be, how much interim interest will the buyer pay at closing? So step one, calculate the daily interest. So you take the annual interest, that is the $325,000 purchase price, times the 5.25% interest rate. That gives you an annual interest rate of $17,062.52. So now with that annual interest rate, you divide that by 365. That gives you $46.75 daily interest rate. Now, calculate the number of days remaining in the month. So from October the 14th, to October the 31st is 18 days. So now you take 18 days, multiply that by the daily interest rate of $46.75, then that gives you $841.50. That is your interim interest. Let's talk a moment about reserve or escrow accounts. Lenders often collect money in advance for property tax and homeowner insurance. This creates an escrow account. The lender pays those future bills from that account, but the buyer deposits those funds at closing. Rental properties. Let's say if a tenant has already paid the security deposit, the security deposits are transferred to that buyer. If rent has already been collected, then the rent must be prorated between the buyer and the seller. So remember, the buyer becomes the new landlord and everything transfers accordingly. So here's my biggest recommendation to you. Number one, don't memorize numbers. You want to understand the formulas. Number two, know who normally pays closing costs. Number three, practice closing disclosure worksheet from beginning to end. You'll be amazed at how comfortable you feel with math problems. And then number 4, slow down. Many students miss these questions simply because they read too quickly. Y'all, congratulations! You just completed the review of one of the most important sections of Post 302. Remember these takeaways. Closing disclosure timeline cannot be waived. Buyer usually pays loan cost. Seller usually pays deed preparation and transfer related expense. Purchase price minus due diligence minus earnest money equals cash due at closing. Commission equals sales price times commission rate. Excise tax equals sales price rounded up to the next 500, then divided by 500. Taxes, rent, and interest are all prorated on who owned and used the property. Y'all, if this review helped you, be sure to give the video a thumbs up and subscribe to the channel with the link below and download today's worksheet. And thank you for watching. I am here to help you from licensing to close.